the Doc's new investment option.
Lead bullion.
Buy your ammunition from the Doc today at sdbullion.com.
This is the Doc and Eric Dubin with SD Weekly Metals and Markets. Joining us this week is special guest Koos Jansen, gold expert from ingoldwetrust.ch. It's great to have you here today, Koos. Thanks for joining us.
Hi, Doc. Thanks for having me.
All right, it's our pleasure. A big week in the markets here over the past week with the Fed meeting and Janet Yellen's first official FOMC meeting, and the Fed announcing an additional $10 billion taper Wednesday afternoon with their first press conference. And as we've been accustomed to seeing in the gold and silver markets, they were both smashed on the release and then throughout the afternoon Wednesday and into Thursday morning. Silver down close to $1 from its highs, I think, Tuesday prior to the announcement. Silver was trading up around to 21 and smashed just around to 2010 as the low on Thursday. And gold also hit pretty hard up. It was early in the week. It was challenging the 1400 level and sold off down to a low of 1320. Really not unexpected from what we've been accustomed to seeing on FOMC releases and announcements, but it just comes in the face again of substantial physical gold demand. And I know, Koos, you've been documenting that substantially on your site. I think just recently you released that Chinese gold demand is already at 488 metric tons year to date, and that's up 29% over the 2013 numbers, which were already off the chart. So the Chinese continues to suck down just about every ounce from across the globe. Is that right?
Yeah, it's amazing. Everybody's wondering where this gold is coming from. I don't know, actually. Well, in the beginning of 2013, we thought we knew because we saw GLD draining. We could see all the import and export numbers from London and Switzerland and Hong Kong. But GLD isn't draining anymore. It's sort of stabilizing, so we don't really know where it's coming from. But in the beginning of 2014, the Chinese kicked off in a larger pace than in 2013. I have to add that in April of 2013, the price was smashed big time, and then physical deliveries or SE withdrawals, which equal Chinese demand, exploded in April 2013. So when we pass April, it will be probably more or less the same in terms of demand year to date. But we'll see what will happen after April. The pace now in China is more than 6 tons a day, and if they continue this pace, they will need to import 1,700 tons for the year 2014. So these are just extraordinary amounts of gold, obviously. I'm sort of the only one who is writing about it because I base my demand numbers on SE withdrawals. I did a lot of research about this, and everybody can read it on my website. So these SE withdrawals, the Chinese gold market is constructed as such that SE withdrawals equal wholesale demand in China. So by looking at the weekly reports from the Shanghai Gold Exchange, I can see how much wholesale demand was in China. And last week, that was March 10 until March 14, there was 34 tons of gold withdrawn from the SE vaults. So that was wholesale demand. Wholesale demand year to date is 488 tons, which is incredible again.
And just to put that number into perspective a little bit, Koos touched on the 34 tons of Shanghai gold demand just in the past week. There's been a lot of speculation over the report that the Federal Reserve took custody of Ukraine's gold reserve, and that was a whopping 33 tons. So we're looking at Chinese demand equaling all of Ukraine's gold reserves in basically 5 business days.
Exactly. That is, if you compare all these Chinese numbers with the official gold reserves of, for instance, the UK or India or Saudi Arabia or China itself, which isn't the correct number, of course, because they're not transparent. But It's ridiculous. In 2013, total Chinese demand, the demand what I'm talking about, not the fake numbers from the World Gold Council. Demand in 2013 was 2,197 tons. So that's at least twice the official reserves of the PBOC. So and it's like, I mean, the UK has official reserves of about 300 tons, and demand in China, consumer demand, because these SGE withdrawals are about consumer demand or wholesale demand, not the purchases of the PBOC. It's just staggering, and if I'm honest, Doug, I'm really surprised. I'm sort of the only one writing about this. I've been begging people on Twitter, please debunk my research, but nobody is able to. So all the facts point in the direction of my research of this demand, and I can see the same findings in Chinese media who do write about these numbers. They write the same. STE withdrawals are actually the best benchmark for looking at the Chinese demand.
Right. It is pretty astonishing the level of Chinese demand has been and how it's been sustained really over the past, it's been about 10 months now since you touched on the big takedown in April last year where the demand really kicked off. So it's nearly a year of massive sustained demand.
Yeah.
The other thing I want to talk about here a little bit is just the whole continuing crisis and now the sanction war between the U.S. and Europe and Russia over the Ukraine and Crimea. And the big news just in the last 24, 48 hours here on Friday that Russia is working on deals with China to trade oil directly and bypass the dollar, which is, I'd like to get your thoughts here, Eric. Obviously, Russia has the option of pretty much a nuclear economic weapon, if you will, of they decide to totally bypass the petrodollar and sell all of their gas and oil reserves for either whether it's gold directly or else other currencies such as renminbi and yen, or whether it's the real or euros, anything other than the dollar.
Sure. Even if they choose not to throw that switch immediately, and as it pertains to the whole petrodollar empire, even prior to that aggressive a level of move, they have the option of just curtailing flows from the Ukraine piping system into the rest of Western Europe as a very powerful weapon, particularly in natural gas, where Europe receives about 25% of its natural gas from Russian sources. So, this whole sanction theater, it's like a kabuki theater that we've been going through in the last week or so, is dangerous and silly because the sanctions to date have largely been show. They initially in the United States targeted the assets of 7 oligarchs in Russia and a couple of people in Ukraine, and it really doesn't do much of anything, particularly since most of those individuals had moved the lion's share of their money out of assets and corporate stock. There's one in particular as an example that an individual had removed his entire holdings of I believe it was Gazprom. It may have been a different energy company. My memory escapes me at the moment. But in any event, this has been more show than anything else. And the point is that it's raising escalation of tensions and the likelihood that in the months to come, we're going to see real actions with real commodities and real economic flows that impact pretty much everybody, and the weakening of the petrodollar standard. And this is a process, an evolution that's been going on for years, and it's accelerating. As I pointed out last week, we have seen these geopolitical tensions escalate precisely at the exact time that we've had G20 meetings discussing as the primary agenda item the world reserve and trading status of the dollar system. And both China and Russia are very keen on moving the world away from that system because it greatly benefits the United States' interests versus what the BRIC countries in particular, Brazil, India, China, Russia, and South Africa. And, they want to see, and alternative currency system come into place that is more into their geopolitical interests. So this is yet one more card in that deck, and it's playing out before us. The G20 meets next in April, and China is going to have as the primary agenda the discussion of reforms with the IMF and the currency system as it goes forward. So we're going to see a lot more of this in the news in the days ahead, although it probably won't be reported much in the United States.
I wanted to touch on a little bit here. Big news for gold this afternoon here on Friday, as gold has completed a golden cross. It's something we've been talking about on the show, looking for over the past 4 to 6 weeks, where gold's 50-day moving average has cleared and is now trading above its 200-day moving average. One of the more classically bullish chart signals. The last time a true golden cross was completed was early 2009 after the big Lehman collapse in the metals, and we saw gold trade from a low of, about 675 or 678 in the post-Lehman crisis to a high of 1915 in 2011, so a little over 2 years later. What's your take, Eric, on the Golden Cross signal today and what it portends for the gold market moving forward in second half of 2014 and even beyond?
Well, it's ironic that we get the Golden Cross today, and in fact, all throughout the whole week, you saw Cartel profit in taking incentive with their tapping of the markets and having the momentum traders follow them in the wake of the FOMC meeting. But looking at the bigger picture, we still are in this general upward movement trend that should continue for the better part of this whole year and beyond, in my opinion. I mean, given the depth and the duration of the the shorter-term bear trend that we had over the course of a couple of years and the mauling that began in April of last year, we're still in the process of just bouncing back from that. And there's these ongoing risk factors of the geopolitical nature, but more importantly, just from a currency renegotiation status. More and more people are beginning to understand that that's going to be in our future. No one knows exactly when, but it's anything from 6 months out to maybe 2020 at the absolute latest, but probably only a couple of years away given how fast things have been occurring. The very wealthy and smart investors, both large and small, have been well aware of this, and you can see the way that they're positioning themselves in hard assets as well as assets that can rise once the reset occurs, and that includes standard equities as well. And part of what's going on in our stock markets, particularly in the United States, is it's being bought as a safe haven asset. As the dollar is debased with QE, that although it is being tapered, is still a significant amount of money. And in addition, this whole understanding of an eventual currency event where the global status of the U.S. dollar is transferred into some other kind of relationship vis-a-vis other currencies, most likely in some kind of a currency basket. Maybe even there would be two currencies, where one would be based on the trade, and then domestically we'd have a different kind of dollar. But bottom line is that gold and silver are going to continue to respond to that ongoing threat. They can't hide this under the covers. More and more people are beginning to understand what these risk factors represent, and that's why there's a consistent interest in these assets worldwide, and slowly but surely Americans will come to the table, even though they have less than 1% of their net financial assets in gold and silver.
I think the whole world realizes that we need a world reserve currency that is not a national currency. I mean, the idea is just ridiculous to have a world reserve currency that is also a national currency. So one nation can influence the prices and economics of other countries. So I think everybody will rush to gold in the end as the world reserve currency.
Yeah, either that or something along the lines of what Jim Rickards has been talking about. I know that you and I and the doc were talking about Jim Rickards before we went on air, and he's been positing the theory that it'd be pretty high probability we get a new IMF basket where gold has a weighting, maybe 25%, who knows, then the United States would see its weighting in a new reserve basket at somewhere around 20% or so in relation to its share of global economic output. But then brand new to the table would be Russia with their ruble, and China with their yuan, and Brazil and other major players coming to the table with a share in this new SDR basket that could be printed out of thin air under the IMF's auspices and serve as an independent liquidity pump, as Rickards describes it, so that you wouldn't have necessarily the United States dollar being the prime liquidity pump, and then all of the unintended consequences that come with the creation of that credit system expanding, as opposed to something that would be independent from a single nation state. But who knows? I mean, with all of the aggressive actions that are going on geopolitically in Russia and China and the United States basically being the main players when it comes to the world currency system, and BRICS following in the lead of the Russians and Chinese, might get something sooner rather than later, and it might not be to the best interest of the United States, given how, for lack of a better word, arrogant we have been with the so-called exorbitant privilege, as our former Treasury Secretary had described it many, many years ago in the Nixon administration. It'll definitely be interesting to see.
The IMF is already rolling out the SDR. They're already working on it to let it become the world reserve currency, and they would like to, be it a basket of fiat currencies. But if a collapse comes sooner, they have to back it up with gold to give it some kind of credibility. So if they get enough time, the SDR will be just a basket of thin air, and if the collapse will come sooner, it will be tied to gold.
And as we've discussed already, you've well documented on your site in Gold We Trust, the Chinese gold demand. I think we touched on 418 metric tons year to date. And correct me if I'm wrong, your analysis is somewhere around 2,800 metric tons that it came in for 2013. Is that right?
For 2013, wholesale demand was 2,200 tons in China. And this excluded PBOC purchases. I now have a few more sources, because when it comes to PBOC purchases, it's really hard to guess. There are very little numbers or evidence or things where you can make fair estimates on. But it's been thought now 600 tons were being bought by the People's Bank of China. Although I must say it's SAFE, which is a sovereign wealth fund, acting for the People's Bank of China, bought this in 2013. So SGE demand was 2,200 tons, and SAFE, the People's Bank of China, bought another 600 tons. So in total, demand was 2,800 tons, and with an annual mine supply domestically of 400 tons and some scrap supply. You could imagine that maybe they had like 700-800 at most of domestic supply, and the rest had to be imported. So my guess for 2013 was they imported 2,000 tons.
So what's your take on how long this can continue? How long can China continue to drain 2,000 tons of gold annually from the West? And what's your take on really the coming end game?
I think this is within 2014, they will need to change something. Or the price has to rise, because I don't see any floating supply in the world left to supply the Chinese. I mean, we just talked about Chinese demand, which is huge, but we also have the rest of the world. We also have India. We have Russia that isn't exporting any gold. We have other nations that are not exporting any of their mined gold. So I would really be surprised to see this can continue until the end of the year. And so I'm expecting price to rise to perhaps at least $1,500 at the end of the year to flip around this Chinese demand, because below 1,500 they will keep this pace. 1,500. And after that, I don't know. I know, the Chinese are, they just want to hedge for their foreign exchange reserves. I mean, they have far too many dollars in foreign exchange reserves, so they want to hedge their position. I think they are the ones who are manipulating the gold price at the moment to lower it and to buy as much physical as they can, to strengthen their economy, to protect their economy from internal and external shocks. They're also really promoting their citizens to buy gold. They do this through state television items, reports. They educate their people through the commercial banks. All the commercial banks have financial products for sale. So a lot of these gold products, gold sales, go through the commercial banks, and they're preparing themselves for a new monetary system, which will partially be based on gold, and because China has a lot of cards in its hands, and it has some vote. Also, when they will disclose, they have a lot more official reserves. They have a bigger vote in the IMF, and so they will decide more than the US is doing right now. And of course, they also are buying this gold to give their renminbi more credibility, to internationalize their renminbi. To get more power in the world through their currency.
Koos, I'd love to ask a question that I think would be very interesting to a lot of our listeners to get clarification on. You had just mentioned that China was actively manipulating gold to have a lower price so that they could accumulate more. And I have a different opinion. I think that they are very happy that the gold is lower, and that the primary actor that's doing the manipulation is the United States government, Treasury, the Fed, and its bullion bank relationships with J.P. Morgan and other bullion banks.
Mm-hmm.
And I wonder if you believe that United States hand is active in addition, or maybe primarily the actor, and that China is playing along. And gov't had speculated, and I believe it was Chris Powell who put this thought out in reflection of the research that gov't has done over the many years, including discussions with the Chinese the Sovereign Wealth Fund, and having discussions with them. That it was in Chris Powell's opinion that there's kind of a tacit agreement between the United States and China that China owns over $1 trillion worth of U.S. treasuries, and that it's in a precarious position because of that, and then the United States realizes that to keep a good favor with China, that presumably the gold manipulation would allow China to accumulate more gold, and that they're kind of allowing that to happen. All of this is speculation, of course. We don't have any concrete data or some kind of WikiLeaks type document from the State Department or whatever that would surface many years in the future.
No, but we have a lot of motives, right? If you mean, if you look at the markets, if you look at what the price of gold has done, if you look at where the physical gold has gone.
I totally am of the school of thought that there's absolute manipulation going on. I was just referencing the fact that if it comes to some kind of backdoor agreement between China and the United States, we don't have any data or documents that speak to that can prove it. We can certainly look to documents and see ample proof that manipulation is happening and that the United States is behind it. But anyway, then the question I basically wanted to get more context from you and your views is what degree to which you think the United States is acting as a primary actor, or in fact, if you really think that China is the primary actor. I'd love to get your thoughts on that.
Yeah, that's a really interesting question, because I'm actually going back and forth between theories for a couple of months, but I think since 1971 or whatever, it was in the interest of the United States to suppress the price of gold, and not only of the United States, also of other countries, in order to keep to control the monetary system based on the US dollar. But that has sort of changed, because for the last couple of years, the United States really wants inflation, and it's not getting any inflation. And so they actually want the price of gold a little bit to rise to raise inflation expectations, but they just wanted to rise orderly. So this magnificent drop in the price of gold in April 2013 was really not in the interest of the United States. So then we maybe have to look at China, who is the biggest beneficiary of this drop in price. And it can maybe be a collaboration. I mean, just like you just said, China owns $1.2 trillion in treasuries, and obviously the United States and China are in some kind of economic marriage. And I'm sure Yellen and the Chinese central banker call every now and then about markets and about the price of gold. But I really think so. We actually have three scenarios: or it was the United States, or it was a cooperation, the drop in price between the United States and China, or it was China. And I think it was China because they're the biggest beneficiaries. And but though the question then arises, why is America allowing this to happen? Why are they allowing all this physical gold to flow to the east? That is something I haven't worked out yet, but it's an interesting discussion. What do you think? Do you think it's a cooperation, or it's the United States behind the price manipulation?
I think there's an element of cooperation, to be sure. How much is not really clear, but certainly I take the other argument position that the lion's share of the manipulation is being done by the hands of the United States and its tools, the Treasury, the manipulation of the COMEX and the London Bullion Exchange, and the paper movement. Like the tail wagging a dog. The lion's share of the impact of lower gold prices has been executed and facilitated by the paper markets. And when it comes to who's the god sitting above all of those markets, it's the United States financial interests through the bullion banks. And as someone who's on this side of the pond, I can assure you there's a lot of economic interest in the United States that would deeply prefer to see gold price lower rather than higher, because we've financialized our entire economy with a huge amount of leverage, and we haven't really fixed a considerable amount of the black holes that exist in our banking system. And the real estate market represented such a huge percentage of the growth that came in the last decade and the crash. All of these things have tied together to where the policymakers in the United States are paranoid about higher interest rates. And the smoke alarm in the financial system with inflation, we actually have much more inflation at the retail level in the United States than what's reported, given the way we've changed our economic reporting. And it's well documented through the Boskin Commission in 1994 with Alan Greenspan's participation as but one example of where they changed a lot of the metrics that go into computing the CPI. But to make the long story short, I think that interest rates are the biggest fear, and the rise of interest rates in the United States, and we've seen a huge amount of manipulative activity every time we get anywhere near 3%. And on the 10-year government security, which basically is the benchmark for our markets for everything else. And gold and silver are manipulated primarily to keep interest rates down, which helps to keep everything from exploding or imploding, as the case may be, if it's a deflationary bust. So,
and regardless of the culprit, I think we can agree with Koos that in the end, the result is going to be that everyone will rush to gold. Is what we're going to see. And as far as your prediction for 1,600 gold in 2014 on Chinese demand, I think we're going to see at least that. I know both Eric Sprott and Jim Sinclair have just recently stated that we'll see new highs, new bull market highs this year, definitely in gold of 2,000. So I think it won't be too hard at all, particularly with the Golden Cross in a rearview mirror. to see gold start to accelerate to the upside and get a little bit of a momentum traders behind it, and the hedge funds and momentum trades piling on to the long side, which in the past 18 to 24 months they've been piling on to the moves to the downside. I think that's a good point to wrap up here. For any of our listeners who haven't checked out Koos's work, we highly recommend you check out his website, ingoldwetrust.ch. Some of the best research on the gold market and Chinese gold demand. And want to thank you for coming on the show. It's been our pleasure to have you, Koos.
Thank you very much.
Okay, so for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.